How you doing, ladies and gentlemen? Richard back again with another video about stocks. A little itchy nose here. Today's video is about buying. Last video was about selling. And one of the major differences between what we do and what other people do is, in fact, the selling. We don't buy low and sell high. What we do is we sell high and buy low. And why is that different? It's because if you get in the mindset of buying low, you buy the dips, you very rarely sell. If you have the type of stocks that are slow performers, like dividend payers and slow performers like that, you really can't sell. You have to be 100% invested to make it worth your while. The type of stocks we have 25% in cash at the tops of the markets. We'll get to that in a moment, but we can afford to do that and still run 80% rate of returns. Our portfolio is running above 80% rate of returns right now. I understand somebody's made a spreadsheet. Please put the information in the comment section so other people hear it from you rather than me. You telling what your performance is, what your spreadsheet says, is much more effective than me saying what it is, okay? So please do that for me. I'd really appreciate that. So what is the difference between what we're doing and what other people do? So I want to make this really clear so you understand the importance of selling and buying and recirculating and compounding the profits. And the difference is this. People, you might have watched videos where you say, oh, I bought the dip. Well, what does that mean is they took new money and bought the dip and they think that makes some kind of significant difference. It does not. So here's why. You have the original amount of money, you add new money on the same day. All you're doing is you invest it here, time goes by, there's a little dip, you create a new timeline where you get an initial pop from that dip, but over time it's just another 6% bag of money. That's all it is. It does not add or increase your yearly percentage return by adding new money at the same crappy 6% rate of return. And that little bit of boost you get for buying on the dip over time, it may be 7% in the first month. Then it drops to 6.8, 6.5. And before you know it, it just flattens out to 6. And their stated goal is they buy high, they buy in the middle, they buy low. Doesn't really matter when you buy, just buy, buy, buy. So it makes no difference. What we're doing is really quite a bit different. What we're doing is we're taking our bag of money, we're slicing some off the top, 25%, so that we have less of a pile of money on the way down. So we're losing less on the way down compared to that other pile of money, number one. Then we take that substantial part of profits on profits on profits money, we put it into the bottom, so now we actually are increasing our annualized rate of return. It's two entirely different things to lose less on the way down and make more on the way up with the same pile of money than it is to essentially have two separate piles of money at the same time starting from the same place. That's all you get. Your original bag of money is going to go back to zero. Your new one's just on a new timeline that's getting 6%. That's all it is. So I want you to think about what it is that we use as a guide to when we want to buy in the first place. And what we use is that 25% in cash. So let me go over what happens in case it hadn't kind of dawned on you already. At the top of the market, it's going to be 25%. When the market falls off the cliff, that 25% is going to get bigger and bigger and bigger. So at some point, the market's taking a good run down. All we really want is 25% when it rolls over. So everything above 25% is fair game to throw at the market, whether it's the bottom or not. That's almost a free pass because you're still going to have 25% in cash. The market's gone way down. You might as well use that first tranche of money. Just like buying, we want to tranche up our money a little bit. We don't want to go all in all at once unless we're talking about day trading, and we're not. So that first tranche of money, that's just a free pass. Slice it right down to 25% and you're in like Flint. the market keeps dropping, that 25% raises up again. You look at the big picture environment, you may want to drop it down so you only have 20% or 10% or whatever, put a lot of that money in at the bottom, then it's going to work for you. So let's say we started with 15% in cash at the bottom. Well, that 15% is going to shrink pretty quickly, and it's going to get less and less and less and less as the market goes up. So as that shrinks down, and this is the important point here, this is a 2, possibly 3-stage process. We're not trying to buy at the exact low and sell the exact high. All you really have to do with this is buy it back for less than you sold it, which can be accomplished very, very easily. Okay, so don't let these, you can't pick the top and the bottom people, blow me, okay? We're not doing that. So once the smaller cash pile starts to get a little bit smaller, you're going to raise that up to 25% again. So you're going to take a little bit of profit. You're going to get a little bit of profit from that money from the bottom. But now you're not picking the top. You're still kind of a ways from the top, which is fine. Now that 25% is going to shrink some more. When that 25% gets small enough, because the market's gone up past your little recirculation profit period, then you're going to raise it up to 25% again. You're going to look at the RSI to see if that really makes sense. But mostly, it's your pile of cash that determines these things. It's not how high the stock goes. You can't figure that out. You don't know if a PE of 38 on Amazon makes sense, which would put it at a $1,500 stock, a PE of 70, so it's 26, or the guy that said it's worth $4,000 or $5,000 yesterday is right. There's no way to know. But what you can know is that you want 25% for emergencies, and you've only got 10. So you can raise that up. See, the RSI is about 70. So what happened here recently? I made a video telling you the RSI is above 70, do not buy stocks. Because the RSI is above 70, that should indicate to you, I believe I mentioned, to get your 25%. There's another guy that made a video the very same day saying it's a great time to buy stocks, one of these dollar cost averagers. Market dropped subsequently 2,000 points. Since I was at 25%, my cash is up now, not up a lot. I sold 2 puts on Beyond Meat for $500 a piece. I sold 1 on Amazon for $2,000. I made like $2,500 in 2 days. There's about $250, $300 hanging on. I'll just wait till Friday and let it expire. To be honest, that's probably a mistake. I should just blow off that $300 and take the money while the taking's good. But no big deal. For whatever reason, I'm obstinate about it this week. But the point here is, what I'm trying to get to is, let's say you did not have 25%. Maybe, well, the RSI is at 70. I'm going to wait until it's 72 or 3 or 4 to get my 25% in cash. That's okay. I'm not saying that's a big mistake. But here's the part that would be a mistake. If the market had dropped that 2,000 points, and let's say your cash had now gone up, but it had only gone up to 24%. Well, you're not even at the 25% level because you didn't start it with enough at the top. That would mean that you would not have bought those sold those puts, because you don't have the proper amount of cash. And when the market goes back up, realize that, adjust, and next time have more cash at the top, so when it drops, it goes above that 25% level, and you can take advantage of the next 2,000 point or 1,000 point or whatever it is downturn. But you understand the idea. It has more to do with our cash level than it does the price of the stocks, the overall market, the big picture. This is a much smaller, more narrow picture having to do personally with your cash management. And once again, the reason I like the stocks we like is not just because they make the most money, but they also allow you to we're making above 80% rate of returns with 25% in cash. So we can always be prepared for emergencies and be making fantastic money at the same time. I was watching CNBC the day before the crash, or the little crash, whatever you want to call it. They were headline the 6 best performing stocks of the day. Every one of them was in our portfolio. This time around, we hit 7 new all-time highs instead of 4. What that allows us to do is to keep a significant amount of cash to take advantage of these downturns. If you have to be 100% invested because of your dividend payers, that's the way it is for you. But here's the real problem with that. And here's the other thing we're trying to do. We're trying not just to lose as little as possible in overall money, not just as little as possible in potential profits. We're also trying to lose, very important, as little amount of time as possible. When you start with your whole bag of money and the stock market goes down, it goes back up, that V of time is this long. When you start by shaving 25% off, putting it in at the bottom, that V doesn't go all the way down to here, it only goes to here, and it gets up to zero quicker. So you've shaven hopefully less than half of the amount of time that other people have, which in a sense, what that does is your investment career isn't a linear graph. It is for the 6 or 8% people, but not for us. It's a mathematical curve where the longer you're in, and to some extent it is the same for the lousy return investors, but it's a mathematical curve. So what we do is by shortening up the times, by slicing that 25% and recirculating it, we have 10 extra years at the end. So if you invested for 30 years, normally your last 10, your 20 to 30 are really good. It's the compounding on the compounding. Our last 10 years will be like it's 30 to 40 years, not like it's 20 to 30. Because every time we shorten up that distance or that amount of time where we're getting back to zero is more time we have to make money. So we jump ahead of the other people every time we shorten up that gap of time. This is a very important process, that procedure, whatever the word is, sorry, I want you to understand, because this is another reason why we use options, why we would sell call options, something I talked about at the very beginning of this whole fiasco. We use those call options because it adds cash and it gets us back to zero, shortens up that timeline, okay? So I want to make this video short, but I really want you to start concentrating on what happens with the fluctuations of your 25% cash pile. Now down the road, that's going to change. One of the ways we take full advantage of the long length of a bull market is by lowering our 25% down the road to 10%. That means the cash is going to go when the market goes up, but we're not going to sell anything because 10% is going to be our new number. So we get full advantage of that long runway after the presidential election, should things go halfway decently. For example, after a long bull market, I wish I'd started making my videos a couple months sooner. At the end of a tail end of a bull market, I would have told you we need to have 25% in cash because it's going to roll over when we least expect it. If it hadn't been COVID, it had been something else. It was a 10-year-old bull market. It was bound to happen. Everybody should have already had 25% in cash. 25%, somewhere in there. And you should have sold some at the rollover. So you started off the fiasco with somewhere near 30% in cash. When it dropped 30%, you'd have plenty of money to get back to zero very quickly a long time ago, especially if you have the kind of ass-kicking alpha portfolio stocks we have. But today's lesson on adding alpha is to take a look at that cash pile you have, and is it appropriately high enough to invest in the dip, or did you make a mistake by not selling soon enough so you can't buy? We don't just buy low for the sake of buying low. We sell high and then we can buy low. If we forgot to sell high and we don't have enough cash to protect ourselves in case we're wrong about the bottom, you just hold them and do a better job next time. So, I've got a couple comments about the Thai vlogosphere. My first comment is, if you're invested in the stock market and you live in Thailand and you've never seen a Honda Civic, you need to become a little more observant, okay? And I'm making a joke at your expense there, Mike, but I'm telling you, you're going to see nothing but Honda Civics everywhere you look for the next month now. The fact that you haven't seen them yet, it just blows my mind. I don't know how you could have missed the 10 million Honda Civics driving all over Thailand. And, by the way, Lexuses and Toyota are just called Toyotas. You can buy a Lexus LFA in Japan. It's called a Toyota LFA. That's the only difference. They didn't make a whole bunch of new dealerships called Lexus to sell those models. That's the only difference in Lexus. And I guess I won't make the other comment about what I was going to talk about.